another pretty historical day in terms of the pound and price movement, up there with some of the biggest moves we've ever seen. You can see on my chart here, just having a slight issue here. Not sure what that is. Anyhow, back to the pound. Overnight, we had a pretty phenomenal move to the downside, and this occurred at 7 minutes past midnight. Now, I got a message from Will first thing this morning. I'm on my way in. Get in. Have you seen the pound? I thought, 125 we've broken. 120 more like was the call. The interesting thing about this is that for the new guys, this is when you see this type of price movement. For one, as soon as I saw the chart this morning, I pretty much knew specifically it was an algo move. It was it's quite not maybe to this sort of size, but it's not unusual to see price movement like that at that particular time of day. If you were to take advantage of the thinner liquidity, if you wanted to actively move a market, then certainly the overnight period is the most susceptible for that. Let's not forget as well, it's a Chinese market holiday, as it has been all week, so volumes overall have been down this week in Asia Pac trade. You've also had the Jewish New Year holiday going into Yom Kippur as well, so we've had some lower volumes overall for a week on average in the US. And what happens here is, this is really an algo-driven move, and other reports that I've had are of just general option barriers being taken out or triggered, and then it just hits one level to the next, 25, 24, 23 in very quick fashion. Now, if you saw that move in real time, probably it would have occurred in a matter of seconds. Now, when it comes to one single fundamental headline, as you saw, the nearest comparison I can give you is Brexit. Was, you had a staggered move. Let's say when Sunderland, Newcastle came out and Swansea came out, you saw a wave low of around 100, 150 pips. It leveled, then it went lower again, leveled, then it went lower again. This would have been just pretty much one straight line, and this is when it's the bots that have taken over rather than the humans. And given the thin liquidity, certain signals just fire off and they all start. They all get triggered all at once, and it just escalates into this monumental momentum to the downside. The other thing here is that so that was around in the futures at least, in the debt contract, about a 4.6% sell-off in the pound. But then within, I would say, 7-8 minutes, you'd pretty much reversed 2/3 of that move. And so again, if there's a fundamental reason for the asset to go down, although you normally get a spike and then it might pull back slightly, then another push down. You're talking about a pullback within 3 minutes off that low of, 450 pips. So no small fry move there. And then since then, we've leveled out. And granted, we are down still, sub 125, which I think is quite interesting from just a psychological barrier point of view. That was kind of the next area that the market was looking at. If we look at the pound on a slightly longer chart, it might put in a bit of better perspective. So that the real areas here to focus on are, that was Brexit. Obviously that move kind of dwarfs the one we saw overnight slightly, but certainly that's the move overnight is, as I said, we'll look at a table I'll show you shortly. It's pretty much, I think, the second biggest move that we've seen on an intraday basis. But then cable was defined by that range for some time, really, up until we broke that key post-Brexit low that was seen on the 6th of July. That gave way at 128.06. This coinciding, of course, with the hawkish turn or the push of hard Brexit from Theresa May. And various other comments. We actually heard Mark Carney saying pretty much along the lines of he agreed with May, which was actually, I thought, quite significant at the time, given it was the governor, and the governor obviously was more pro-Remain at the time of the vote. But nonetheless, the trend has been lower since, and then 125 was kind of the near-term target for eventual year-end target we've been talking about of 120. The only thing is we got there last night, a lot earlier than you would have imagined. A quick look then at the table. This puts in a bit more better context in the size of these moves. And the top 4 or the top 5 really make sour reading. I mean, that's the Brexit. I mean, you're looking at an 11% depreciation of the pound on that day. Last night's move was more 6%. So, not quite to the same scale, but nonetheless, the second biggest intraday fall on record. The worrying thing about this as well is that this is the future. And in turn, what I mean is that technology now, it's quite worrying that machines can cause such a monumental shock in the market. Now, the difference being that if this was during equity trade in the index futures, is that you have circuit breakers in place pre the open of cash markets. Then the cash markets, they realign those to new percentage levels on all of the indices. This is to prevent a flash crash turning into a collapse of a stock market. The only problem is that doesn't occur in FX markets. So in theory, you could just keep selling. The other ones, obviously, 2008, you can see in 3rd and 5th spot, they were the financial crisis, so shortly after the Lehman's collapse and thereafter. And then 1992 as well, Black Wednesday was that run on the pound that we had at that point in time. So it's certainly one of the biggest moves that we've seen. Now, looking at it at the moment, obviously price action has stabled out, and maybe at this point, for the here and now, cable, although keeping an eye on, might not be the exact trade to take on at this present point. Looking at the indices, potentially more interesting. We've already seen some downside pressure coming into the DAX since the open of cash markets. The futures kind of hovered, and then as soon as the cash markets opened, we've moved lower, breaking through yesterday's low, and now we're looking to target S2, which also coincides with that low point that was seen on the 5th. Now, the interesting point here is more to do, and Will's going to jump on and share some of the trades that he's executed this morning, but it's about the market psychology. And although this move in the pound was on no specific news, it's certainly going to test the market's confidence. And that leads us on then to one of the other charts or articles that I want to share with you. And it's really talking about, there's no smoke without fire. And generally speaking, when typically we've had these kinds of spikes, it normally leads to negative sentiment. And don't forget, although we've had a generally hawkish tone of late and positive economic data out of the US and the UK and so on, it doesn't take a lot for these markets to turn. And quick look at some of the ones that we've seen before. May 6th, 2010 in US stocks. I remember that day quite clearly. The Dow dropped 9.2%. It was the biggest intraday percentage loss since 1987. Erased more than $1 trillion off the market value. Again, automated trading strategies got the blame. You'll see a recurring theme here. US Treasuries, October 15th of 2014, rapid buying and selling caused Treasury yields to plunge and then rise, covering a 37 basis point range during a 12-minute period. High-frequency funds were to blame. So in a 6-minute window, banks essentially pulled out of the market, providing no or very few offers, and at the same time, high-frequency trading firms exacerbated the situation by often being on both sides of the trade. The list kind of goes on. You're getting the point. And then, as I said, for the conditions that are prevalent from overnight trade, that's when the market is susceptible to these types of moves. So moving forward, I would say this morning is going to be quite interesting to see, does the pound see any type of pullback? I guess the most natural place and point now is 125. I mean, looking at 125, that's pretty much when you had to spike lower, when we started to pull back thereafter within the next half an hour, that's, again, it's not rocket science, it's just market behavior, I feel. You go straight back to almost to the tick to 125, because that's the big level everyone's focused on, and then it pushed back, and now we've kind of gravitated around that level. I would say 125 upside will be the upside resistance there at this point, or at least the big technical level to look at on the upside. What I'll do is, before I go on to the calendar and talk about non-farms in more detail, let me just swap with Will. He can share with you some trades.
I'd like to do that, but I've just got to...
Okay, Will's in a position. So let me crack on with the non-farms then, and hopefully he can jump on and share with you a couple of trades from this morning. So looking at the calendar, this morning you do have the likes of UK industrial manufacturing production. I would keep an eye on that, but let's face it, there's bigger things at play here given the move overnight. The data, most likelihood, given the way that UK data has gone, is going to be strong. I think people have kind of got over that now and are looking at the longer term picture of hard Brexit, and that's just a medium to long term downside risk for sterling currency. We then move on then to the big event of the actually thinking about it, this could be another reason why you've had such a big move overnight. So as per the hours, it being Asia, the market holidays in China, the Jewish holiday that's been prevalent this week, the other thing as well is that it's non-farms. And typically most people will be completely out of the market at this point waiting for the jobs report. So maybe as well that could have exacerbated the thinner liquidity in overnight, and as such makes this move even more dramatic that we saw in sterling currency. So there are certainly a couple of things to play. Just so you're aware, some of you may have read Bloomberg pinning it on Francois Hollande's comments. I can reassure you that has nothing to do with this move. I know journalists, plenty of them, they get strict, explicit orders from their boss to find any reason, whatever reason, just have a reason, is kind of the instruction a lot of them get from their editors. And Francois Hollande, I don't think, has done anything in his life rather than move the pound by that much, but there you go. Non-farm payrolls, moving on. Let's have a look. This is the 12-month tracking of non-farm payrolls. First of all, let's put in a bit of context. So, market expectation has been growing. Let's just quickly have a look. We've had ADP, was a slight miss, certainly consistent though with the pattern that we've been seeing over the last few months. Not enough to really change any market expectations going forward. Other than that though, we've had the things like durable goods, consumer confidence have all been particularly strong in the US. And then we had that really impressive figure this week in ISM non-manufacturing, where it jumped to 57.1. That number here was the highest since October of 2015, a reversal of the 6.5-year low we printed just before. An absolutely fantastic number, coming in recovery of that poor data that led to a lack of decisions to pull the trigger in September from the Fed. So interest rate expectations for December have been increasing. We're now up at around 65%. Even November is tracking above 20%. Where does this lead us? Well, non-farms as a headline print has been above 200. We're looking at around 240 on a 3-month average, which is generally what the Fed tend to, and analysts focus on. Not just one figure, particularly when you've had such a volatile low and high of 24 to 275 in such a short period. The Fed obviously want to see some consistency. Now, there are, well, looking at the consensus for today, let's flick back to the calendar. The headline reading is expected at 175. So that put us pretty much there. And I would say that really, I mean, I've been reading what Deutsche Bank have been saying, and an interesting point here is that even after this report, we still get 2 more non-farm payrolls before the December FOMC meeting. One would imagine it would take an extraordinarily high payroll number today, along with other employment components being very strong for a November rate hike, to really be in play, with the market currently pricing in the probability of just 24%. The survey range today is 125 to 220. And so for me, really, I think you've got to be looking at a sub 100 or a plus 300, I think, to really shake things up for payrolls to come into significant focus. Let's not forget as well, you've got the second televised debate from Trump coming up as well on Sunday. And so there certainly is 2 real hurdles for the market to cross from the US perspective, because the dollar's been on a very strong upward trend as more expectations build for a deck hike being completely baked in. So this is contingent, though. A number sub 100 today, or in combination with poor wage growth, can certainly pull that number back. But the flip of that can certainly pull this percentage up to around 80%, which is more typically the types of levels that the market is usually priced to when interest rate hikes occur. So that's going to be the big one to look out for later. I would say then that as the market progresses through the day, at this point probably there's a little bit of movement just based on the fact that the market's been caught slightly off guard by that sterling collapse, algo driven overnight. But probably as the afternoon continues, things will get pretty quiet, as they always do ahead of non-farms, as people await the key jobs data. A quick look at 2 varying opinions of what we can see today from 2 of the major banks. Bank of America, Merrill Lynch, they're looking for another weak employment report. Remember, the median consensus is 175. They're going for 140,000. This is Bank of America in job growth, with a potential upward revisions to August. Now, they note a seasonal pattern. They say August and September historically surprise on the downside, and then a revised higher. They also think that there's a risk that government hiring slows after relatively strong growth over the past few months. So they're certainly more downbeat. On the flip side, Barclays, they look for non-farm payrolls to rise to 200,000. So they're certainly more on the bullish side. They also expect the unemployment rate to decline by 1/10. So again, it's quite typical. You see these banks diverge in opinion. This is not abnormal behavior. Quick look back at the charts. Just keep an eye on cable. We're getting close to that level that I was pointing out back at that 125. Again, that was the initial pullback off that spike high, and also that psychological level. So keep an eye on that 125 here, within a 10 pip range again. And finally, another comment just to have a quick look at. Goldman Sachs overnight sees buying opportunity for gold slump if it gets worse. They're essentially saying that strategic buying opportunity may open for gold should prices drop substantially below $12.50 an ounce, with bullion offering investors a way to protect themselves against risk to global growth and limits to central banks' effectiveness. I definitely agree with that, although I would say if you've been following the briefings throughout this week, I've been talking about 12.50 as a big level. I still stick by that. To go long at this point, I think, would be extremely brave. You can see the reason why I'm picking that out is because that was the level exactly where we were trading at before the Brexit spike. And 12.50 is just a big round number that just the general herd behavioural side tends to focus on. I would feel, though, that this level, if we do, as Goldman is suggesting, if we have any big push below 12.50 and we start getting in the realms of that kind of June low that you can see, that 1200 mark, I would say that that's a good level to start hedging yourself for potential political risk that's coming on the horizon from the next 1 to 3 months and going into 2017. That being obvious, the US elections, the Italian referendum, the hard Brexit in the beginning and triggering Article 50 negotiations going into 2017, German elections, so on and so forth throughout Europe. So although this might have further to run, and if we do break 1250, I think we could see another aggressive push to the downside. Anything near 12 could be then starting to come into the realms of being a good buy opportunity again to hedge against those risks on a more macro and political basis. Will, have you got time? Or okay, going to switch over to Will. He'll talk to you about, let me just share, this is what I was just showing you on my chart. Apologies, I had didn't have my gold chart up. Let me just quickly show you that again. That was the Brexit low I was just talking about. There, that's the 1250 mark, and that's 1200 from where we are. Okay, going to hand over to Will. He'll talk you through some of his trades from this morning. But have a good day, guys.
Hi guys, I'll just be very quick because I'm still in an S&P trade here, and the reason for that is the divergence. The S&P is trading above its low for the day. It's quite bullish bid at the S&P at the moment, but obviously you've seen European equities move firmly lower. So we'll just keep an eye on that. Let me just quickly, however, now talk about the Euro Stocks trade and the DAX trade executed today. If I add study, I'll add my order display. You can see Euro Stocks just hovering around this S1 level. It's quite important, actually, this S1 level for Euro Stocks. I think that breaking will be the catalyst for the S&P moving, in my opinion. But here you can see my entry short. Just on S1, and then take out some of it, S2, and then again, as we come back and test that S2 on the DAX, a bit more messy actually. I was trying to get short all morning, and can you see here, just taking it off, it wasn't really going anywhere, but then it was actually on the cash market open. Finally, we had the volume and momentum. And you can see this this move lower down, just down to S1. I've tried it a couple of times now, and it's not really going anywhere. So things have stopped now. But as Ant was saying, you do get, when you get these severe shifts in any type of asset, it does panic markets somewhat. Okay, thanks very much, Ant, back to you.
Okay, thanks all. We're going to be back on later. We'll do a full in-depth rundown for payrolls later. But enjoy your morning and have a good session. Thank you.